In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at Tesla. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For Tesla, this is not looking great for the trailing 12 months, as the earnings per share has increased by -18%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, Tesla have not improved their free cash flow as it is -61%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Tesla's revenue has decreased by 2%. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has improved by 5%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are excellent at 16 and 18%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. And it would take them just under 7.5 years to pay off the debt. At present, with the information we have gathered, it tells us that Tesla's key pillars are not looking too brilliant so far, so let's find out more. Tap the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. In this next section, we focus on other key pillars which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 18%, which is good for the motor car industry, but we would usually like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is 8% and is a little below our target of 14%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 0.23% this looks very poor. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 32%, with the lowest point being this year at 5%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 122%. In the comments section, I've included a link to the investors page in the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures the business has been through. Looking at the chart, we can see that in 2020, the share price began to skyrocket, but started to fall in 2022 and went as low as $113 in January 2023. Since then they have risen but are generally averaging sideways. We can see the current market cap is $735.69 billion. They are currently generating $95.32 billion in revenue. Their net income is $12.39 billion, and they have 3.19 billion shares outstanding. At present, their earnings per share tells us that for each share of stock, the company earned $3.56 of profit. And the current P ratio is 64.75, which suggests the company is a lot higher than the S&P 500, which has a PE of about 27. With the overall consensus being a hold. On average, the analysts believe that the price target should be about $208. It is also predicted that their sales growth will shrink by 45% this year, but it is estimated they will grow on average about 30% after that. Now I am going to show you how to create a valuation. I will use the current earnings per share of 3.56. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give Tesla's a 28% growth rate. Then, I am going to give them an estimated PE ratio of 30. After that, I will project these numbers forward by 10 years. I then want to receive a 15% return from my investment. This then gives me an estimated future stock price of about $1,261 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $312. Then we apply a margin of safety. At 25% it gives me a buy price of about $234. It all depends on your personal view, and outlook for the company, as well as the return on the investment you would like to see. Please consider sharing this video with someone you think will find it helpful, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of $234 and sold in 10 years' time at our estimated future stock price of $1,261 would be 439%. But this is dependent on our assumptions for the company being correct. In addition, they don't provide a dividend. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Tesla scored 4.5 out of 12. For this, I will give them a cross. As for the past results, on average their share price has been going sideways since January 2023. Therefore, I will give them a cross. Analysts are signaling Tesla is a hold, and predict they will grow on average 30% starting next year. Here they gain a check. Using the EPS growth model I used earlier on, we created a buy price of about $234. Therefore, I will give the valuation a check, as the current share price is below this. According to Morningstar, Tesla have a narrow moat. This is because they are the leading electric car manufacturer at the moment. So, I will give them a check. My final overall rating is 3 out of 5 stars. I have given this a category C rating within my own stock watch list. As for me, personally, I don't feel Tesla are within my circle of competence. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.